So you've been hearing a lot lately about investing. You hear how it's a good way to make some extra money, but no one actually tells you how to get started. Well, you're in luck. You found this video, so I'm going to go over some basics of investing. Now, it's important to note that I won't be talking about absolutely everything there is to know about investing in this video. Otherwise, this video would be 10 plus hours at least. But this video will help give you pointers and help lay a foundational base of information for you to then go out and learn yourself. I uploaded a video recently and it was, I'll link it here, but it was about who I follow and where I go for investing knowledge. So once you've watched this video and you start to know the basics, that will help you then understand the rest of the other guys that I follow. So in short, this video will give you the basic outline, and then the other video will give you pointers as to who to look for to then build on that information, if that makes sense. Now, you may have seen other videos out there that may also talk about where you should go for investment knowledge. And what you'll find is a lot of them recommend themselves and their Patreon and just shit like that. So I'll start off by saying, why should you listen to me? Well, I have no agenda, right? Every other finance YouTuber makes most of their money through getting you to watch them through ad revenue and selling you stuff and sponsors and whatnot. They do make some money through investing themselves, but the dark secret is most of them make most of their money through YouTube, not finance or investing. Now, I make $0 through this stuff. I have no Patreon, I have no merchandise, I have no trading courses, I have nothing to sell you. So this video is basically just purely to help you out, free of charge. There's nothing I'm trying to upsell you. And even if you go back and watch that other video that I linked before about who I go to for investment knowledge, I list so many other people, and I don't once mention how you shouldn't listen to anyone else and you should just listen to me, which is quite the opposite of what you'll hear out there. So that's basically why you should take my word for it as opposed to other people, because I have no financial interest tied into this. Whether you take a lot away from this video or not, I'll receive $0 for it. So this is purely just to help you guys, and this is a video I wish I had when I started my investment journey, because I wasted a lot of time watching a bunch of nonsense. Alright, so we'll start off with the types of investments. There's your classic stocks, there's bonds, there's cryptocurrency, there's real estate, and there's commodities as well. There might be a few more, but these are the main ones that you'll hear about, and these are the main ones you should really be concerned with. So the way stocks work is you put money into the stock, and then that stock either goes up or it goes down in value. Now, you make money if the stock goes up and you sell it. If the stock goes down and then you sell it, then you lose money. Now, there are some tax benefits to this, but that's outside the scope of this video. But it's kind of like when you go and gamble at the casino, you put your money into a poker table, and then the value of your money while you're in that poker table just fluctuates up and down, and you don't actually lose or make any money really until you leave that table. That's similar to how it kind of works in the stock market. So a quick side tangent I thought I'd bring up is, whenever you hear about a really rich billionaire like Elon Musk or Jeff Bezos or Mark Zuckerberg losing several $billion in one day, it's not like they had that cash sitting in their bank account and then it just evaporated. They lost, quote, the money because the value of the stocks that they hold went down. So it's kind of outside the scope of this video, but basically those rich CEO guys need to hold a lot of stock so that way they can keep their CEO status and keep their status as someone who's in charge of the company. So when the value of that company goes down, technically their net worth goes down because they own that kind of stock, but that stock has now gone down. So that's what you'll see when you see the news lines that say they lost money. It'd be similar to if you had like two houses and one of them was a holiday home and the other one was just your normal house. And then your holiday home just burnt down in some fire. In a way, you didn't really lose any money because you've still got your money sitting in your bank account, but now your net worth has gone down a lot because you lost an asset of yours. Your asset has gone down in value, well, because it's burnt down. So I figured I'd mention that just so you guys know that when you put your money into a stock and it goes down, don't stress because the stock can always go back up again. And once it's gone up enough, you can always just sell it off. I tend to just hold my stocks for like a long time, just so that they can appreciate more in value. But that's something I'll probably touch on later in the video. But that's just a really brief outline of how stocks work. You put money into it and it can go up or down, but you don't actually lose any money until you sell it. Or you don't gain any money until you sell it as well. So with stocks, there are these things called index funds, mutual funds, and ETFs. So picking stocks like, oh, I got money in Apple and I got money in Tesla and all that, that's called individual stock picking. Now what these three are on screen, they're like sort of a group of stocks. So an index tracks a particular index, such as the top 200 Australian companies like the ASX 200, or the top 500 US companies like the S&P 500, the top 100 UK companies, the top 225 Japanese companies, etc. So if a company in that particular index fails, like it goes bankrupt or whatever, another company will take its place. So it's not like the top 200 companies in the ASX 200 at the moment will always stay that way. Like it doesn't go from the ASX 200 to the ASX 199 or the S&P 500 to the S&P 476. So an ETF is purchased on the stock exchange. They're essentially an index fund that is bought on the stock exchange. So for an index fund, like I've got money in the ASX 200, but I buy it through Vanguard as an index fund. So I can't actually buy and trade this during the day, whereas an ETF I can. That's sort of the main difference between the two, but you shouldn't really be day trading. Day trading is where you basically sell and buy stocks within the same day by looking at the charts like, oh, I think this is going to go up, I'm going to sell it here, or oh, I think this is going to go down, I'm going to buy it after it's gone down type thing. You shouldn't really be doing that with these kind of stocks anyway. But I guess that's the main difference between an index fund and an ETF. They essentially track the same sort of thing. Marketindex.com.au, that's a good way to suss some of the indices that, these ETFs and index funds track, although I will go over that later in the video. Mutual funds will be elaborated on in the next slide, but we'll wrap up this slide. So the pros of this is it's simple, it's low risk, because it's very unlikely that you're going to lose money over time by investing in something that tracks the biggest companies in your local economy. For example, like if you put money in the S&P 500, in 20 years from now, there's a pretty good chance it's going to be quite a bit, because I doubt the US economy as a whole is going to just completely crash. Like at the moment, there's some fears about the US debt and inflation and all that, but usually they find a way to fix that. In the short term, it might be a bit of a problem, but I doubt it'll be an issue in the long run, but we'll see. But that's besides the point of this video. The point is, if you put your money in something like this, it'll probably be worth a lot more in the future. Simple, yeah, so you just put money in this and you just forget about it. Like, you don't really look at it, you don't worry about how it's trading day to day. You don't need to worry about any potential lawsuit for the company, because there's several hundred of them in some cases. And furthermore, it always tracks the top performing companies anyway, so even if some of them just go bust, others will take their spot. So there's really not much to worry about in terms of this. sort of investing strategy. Generally outpaces inflation and gives better return than interest in a bank account. So yeah, if you put your money into something like this, it's probably going to pay you more than what you get for having your money sit in a bank account, accumulating that very small amount of interest. And generally outpaces inflation. So yeah, for example, if inflation's usually around 3%, the stock market's sort of had a historical return of about 7% adjusted for inflation. So, you know, it's at a higher amount than what inflation is. So we'll touch on inflation later in the video, but basically it's the value of everything slowly goes up. So if you have your money just sitting there doing nothing, it can buy you less stuff in the future. So if you put it in an index fund, it'll grow at a pace that outpaces inflation. The cons of this, you might get a lower return than some people who individually pick stocks, but the data is clear that most people just can't do this. So I guess this can be a con. But the main con for me is it's less fun. So I actually find stock picking fun, and watching the performance of my own personal stock picks grow and fall. So I guess that's another con to mention. But generally, this is a pretty good investment strategy, just to put money into something like this and then just leave it and let it grow. So the top part, exchange traded fund, I'd kind of already touched on that, but there's the info there written out if you want to pause and just read it. Mutual funds, so these are professionally managed funds. So they pull money from many investors to purchase securities, which is basically stocks and stuff like that. There's asset management companies that make investments on behalf of the investors. So this isn't necessarily for guys like you and me, just for your information, but when you hear about what a mutual fund is, that's basically what it's referring to. It's basically rich people giving other rich people their money, and then you guys go invest that on my behalf. So the pros of these, they've got more of a sustained risk reduction. Basically, all the info's on screen if you want to just pause and read it. But it's basically, if you invest money in like the S&P 500, there's a chance it can go down, you know, in a couple of months. And what if you need your money right then and there? You're in a bit of strife. So a mutual fund or a hedge fund will basically sustain the value of that money for the entire year. But that's kind of outside the scope of this video. There's a bit more info on screen if you want to pause and read, but this isn't really applicable to guys like you and me. But again, I just mentioned it just for your information. So whenever you hear people talking about a mutual fund, that's what this is. And the cons of them, usually the people that manage them charge really high fees. And ultimately, you're probably just better off putting your money into an index fund or just doing your own research. But that's basically what mutual funds are. Moving on. So this slide's just a bit of a side tangent. Tesla is technically an individual stock, but I treat it as a mutual fund just because it's where Elon Musk puts all of his AI robots as well as his electric vehicle company. So there's a lot of good stuff with this stock. It's in a bit of a dip at the moment, but it's a good stock nonetheless. Now, how do you go about investing into stocks? Well, there's quite a few investment platforms out there for you to pick from. So I use Vanguard for my ASX 200 index, and I've also got an Australian high growth index fund as well. eToro, that's for my individual stocks. This will be elaborated on later in this video, but that's another one I use. Hood, which is Robinhood, that's actually not available in Australia, but I know it's very popular in the States, so I'm sure most of you guys have heard of that. So for those of you in the States, obviously maybe just stick with Robinhood. Webull, I know that's also in the States, I think the UK as well, based on what I've seen from other finance YouTubers, but that's also not available here in Australia. Raise, now I think this is more an Australian thing. Now, Raise doesn't let you invest in individual stocks, but it gives you a wide variety of sort of portfolios to invest in. And they've added this new feature recently called a custom portfolio. It's where you can pick certain segments like, European markets, Asian markets, the US high growth sector, commodities, etc., and just pull them into a portfolio. And then you invest your money into that custom portfolio, and then depending on the percentage you've allocated to each sector, your portfolio will grow according to how those sectors are growing, if that makes sense. And another one is Spaceship. So Spaceship gives you the opportunity to invest in 3 managed funds. eToro, now this lets you invest in individual stocks, but there are some pretty high fees with this platform, but I don't really have much of a choice in Australia. There are a few other investing platforms such as Superhero, CMC Markets and CommSec here in Australia too, but the problem is they've got brokerage fees, so every time you actually buy an individual stock it costs you money, so their fees are even higher, whereas eToro's just got a bit of a deposit fee. As far as I'm aware, there might be something else, but honestly I don't think they have brokerage fees, which is why I'm with these guys and not any of the other options available to me here in Oz. Hood, yeah, I can't say much about it. It's not in Australia. Same with Webull. Raise. So I'd already briefly touched on that, but yeah, it's just a bunch of indexes you can buy, and their fees are $3.50 a month. Here in Australia, they may go up depending on how much money you have, but for most of us it'll just be $3.50 a month. And Spaceship, yeah, no individual stocks either, 3 managed funds as I just said, and their fees are $2.50 a month. And I know for a fact their fees are higher if you have a lot more money in there, but that's not really going to be a problem for most of us. Now, stock market sectors. So there is 11 sectors in the stock market: materials, energy, industrials, consumer discretionary, consumer staples, financials, healthcare, information technology, communication services, real estate, and utilities. So some examples of stocks there and what they are listed on screen. Now, when people say diversify your portfolio, yeah, buy different stuff, but don't buy all stocks that are in the materials sector, for example. Now, a little side tangent I'll also go on. REIT stands for Real Estate Investment Trust. It's basically a company that owns, and in most cases operates, income-producing real estate. Now, I wouldn't recommend, my personal opinion, I wouldn't recommend investing in these REITs. Just invest in real estate if you're going to be in the real estate game. The reason is because real estate investment trusts not only have to rely on the real estate price itself, but they also have to pay all their staff and operating expenses. Now, there are some exceptions to this statement, but it's probably better just to avoid these in general and just go for real estate as a whole, like, a block of land or a house. So this little graph here shows, it basically provides sustenance as to my reasoning behind this logic. So as of July 30th of the last financial year, this is the breakdown of what was in the S&P 500, which is the top 500 companies. So as you can see at the bottom, real estate was a very small percentage of the biggest sector in the whole economy, even though real estate prices went way up. So if real estate prices went up so much, wouldn't you think that real estate investment trusts would make up a larger sector of the S&P 500? There are some other good YouTube channels out there who do invest in these things, such as Joseph Carlson, which I had mentioned him in my other video on who I'd recommend to watch for investment knowledge. But for me personally, I just think it's better just to invest in real estate in general. Obviously, easier said than done, but if you're going to invest in stocks and stuff, maybe just stay away from real estate investment trusts, just because I don't think they grow at the same rate as the other sectors. But this is just my 2 cents at this point in time. My opinion may change in the future, and this statement is just based on the current facts I have available and my current professional judgment. Again, may change in the future, but do your own research. Bonds. So these are where you lend money to the government and they pay you back slowly over time. Now, I don't actually have any bonds, to be honest, because their performance recently hasn't been too well. They are looking like they're going to increase slowly at this point, but it's still too early to tell, just based on the whole macroeconomic environment. But that's basically just what bonds are. Essentially, they're really safe because the government's not going to really default on their payments, whereas dividends from a company, a company may go bankrupt. Like, the government's a lot less likely to go bankrupt than a big company, I'll put it that way. Crypto. So the digital future, there's 7 types of cryptocurrencies, which I'll go into shortly. And these are obviously very volatile. So volatile is just the price can move way up or way down very quickly, whereas this doesn't really happen too much in terms of like the S&P 500, for example. Like, the price remains pretty steady for the most part. So some people get spooked by this. They put money in some cryptocurrency coin and the next day it's down like 20% and they freak out. But that's just part of the cryptocurrency game. It's quite volatile. So, how to invest in cryptocurrency? There's several platforms you can use, such as Binance, Coinbase, SwiftX, BlockFi, Celsius, FTX. I'm sure there are others. I think maybe crypto.com too. You just set up an account and go from there. Now, I do a tutorial, but the problem is that would take ages for me to do a tutorial for all of these, but I'm sure you can find some online. Binance is a bit of a pain to set up, but that's kind of a good thing because it's more secure. That's the one I personally use. I also have some in SwiftX and some in Coinbase, but I don't actually use any of the other platforms myself. So that's just what I use. Binance lets you pay via OSCO, copy wallet address, open banking app, pay anyone, paste address, pay. It shows up instantly in your account with no fees. So basically, that's a very quick summary of how you can actually put money into Binance with 0 fees. Whereas some other platforms, I know you have to put money in via a credit card or they will take a cut of that payment. But there's no deposit fees with Binance as far as I'm aware, and as far as the methods I use at least. Okay, crypto types. So there's 1, there's a store of value. 2, there's smart contracts. 2.2, oracles because they feed into the smart contracts. 3, payment cryptos. 4, privacy cryptos. 5, exchange tokens. And 6, meme coins. So 1, store of value, for example, Bitcoin. Fiat inflation pressures from printing more money. So fiat is just government money, really, like the dollars in your bank account. That's fiat money. Limited supply of 21 million, can't print anymore. So yeah, there's 21 million Bitcoins in existence and there can't be any more ever. So whereas obviously there can always be more money printed, which can reduce the value of the money, which is why we have inflation, but that'll be touched on later in the video. So yeah, because you can't print more Bitcoin, it can't be devalued. It's just a basic economic principle of supply and demand. If there's a limited supply and the demand keeps going up, then the price of that asset will go up. So that's one type of cryptocurrency. The second type, smart contracts. So very simply, it's just do something if certain conditions are met. It's like those formulas on Microsoft Excel, or for any of like my software engineer type friends or computer science, you put in like a certain code that says if this happens, execute this. Like on Excel, if this statement, then show this text. Basically, it's basically just like that. If these conditions are met, then do this thing. There's no maximum supply of these though, but they do have annual inflation schedules so that way they don't get too out of hand like fiat currency is at the moment. So for example, Cardano is an example of a smart contract cryptocurrency. And yeah, these cryptocurrencies can be pretty useful in law in the future, but it's a little bit too soon to tell. But I think they'll have some useful applications in law in the future. 2.2 oracles. So these bring real world data into smart contract cryptocurrency blockchains. Most apps you use every day require some type of real-world data, including time, weather, price of an item you're buying/selling. Centralized applications will use centralized data fees called APIs that are provided to them by another centralized entity. Weather network providing API data to Facebook to tell you weather in your area. Smart contract crypto blockchains need real-world data for their decentralized apps to have real-world usage. This data comes from Oracle cryptos, such as Chainlink, which is the largest and most adopted Oracle. So very simply, what I just said is oracles are just sources of information to make the smart contract work. And they're already kind of used in everyday life anyway. Now it's important to note, almost all Oracle cryptos have allocated a large amount of their pre-mined token supplies, which is lots of money or stock, to their teams and private investors. So this could be the potential for a rug pull, which is basically where the people who made the Oracle in the first place, because they own a large amount of it, when they sell that stuff to the public, the price of the existing oracles that they hold will go way up. And what they can do is they can completely sell everything and abandon the project. They basically leave with a huge amount of profit, and everyone else who bought in has lost a heap of money. That's simply how a rug pull works. Now, I'm not saying that this is going to happen with oracles, but it is something to keep in mind. But we'll move on. Most smart contract cryptos use multiple oracles for their decentralized app data. Now, Cardano has built its own decentralized oracle data, so this further dilutes the value for any one single oracle crypto. So a decentralized app is basically an app that's not controlled by anyone. So for example, if you post something super offensive on Instagram, it can get reported and then Zuckerberg can take out your account, whereas this kind of doesn't really happen with the decentralized app. And with the whole building your own oracle thing, because smart contracts rely on oracles to work, as the need for smart contracts go up, you would think that the need for oracle cryptos would also go up. But the problem is some smart contracts can build their own oracles, so there's no reason to have an actual oracle cryptocurrency. Again, this isn't something that's guaranteed to happen, but it is food for thought. So essentially, oracles are useful, but they're maybe not as useful as you'd think just because some smart contract cryptocurrencies can build their own personalized oracles. So number 3, payment cryptos. They aim to replace the current payment system. So Visa, PayPal, same thing as what Ripple, Ethereum, Bitcoin, Litecoin's going to be. Foreign exchange is annoying. Merchant fees are annoying as a business trying to take payments. If you've got payment issues at the bank, there's a lot of hoops you've got to jump through. I'm sure most of you guys know how that works out. Most of us are paying fees just to have a bank account or a credit card in the first place. There's always a middleman taking cuts and slowing down the process. So that's where these payment cryptocurrencies come in. They look at removing this middleman and making the process cheaper and more efficient. So some popular payment cryptos at the moment are Bitcoin Cash, Dash, Terra, and Telecoin. Dash is widely used in Argentina, and Telecoin got a lot of traction with low remittance services. However, it's important to note that it's unlikely that these will replace traditional payments for a long time, due to basically how volatile the prices are and how the governments hate this thing, so they're going to push back against this and basically not make it legal for a while at least. Number 4, privacy cryptos. So these basically are designed to keep your privacy when you're using crypto. Now, crypto blockchains are public. Now, your identity is not connected to the wallet by default, but ultimately it's not hard to figure out who's who, especially if you use an exchange that requires your personal information. So some examples of these are Monero and Zcash. So the systems for these are so good that the US government can't even crack these codes. The pros of these are they're quite well designed, and most had fair launch, so that means there was no pre-mining or greedy private investors, so there's very low chance of a rug pull. Now the cons of these, they're a large target for the government because the government thinks that these can be associated with things such as money laundering, which is true, so they're going to push back against this. So most cryptocurrency exchanges won't list these because otherwise the government will come after them as well, and they want to avoid that, which means it's harder for prices to go up if no one can invest in it. Now there are some coins out there such as Thorchain that are looking at fixing this sort of issue, but I don't think that'll be for a little while yet. Number 5, exchange tokens. So they're owned and operated by the crypto exchange that they belong to. It's like a combination of a membership subscription and a company stock. They can offer things like trading discounts and VIP token/coin sales. Performance of an exchange token relies on the actual exchange itself, much the same way stocks work. Crypto.com, CRO skyrocketed. So when Crypto.com announced that they were going to have the naming rights to the Staples Center, the CRO coin skyrocketed because the value of Crypto.com in general skyrocketed. Now, almost every exchange will do buybacks and burn some of the circulating supply of its exchange token, so this is good for inflationary pressures as well. Binance has built smart contract cryptos that require their exchange token to use, which adds further demand for these tokens because there are some smart contracts that can only be used with the Binance coin. So if people can only use Binance coin, then they're going to have to buy the Binance coin, aren't they? Now there is some risk with these because there's regulation issues. The bigger an exchange gets, the more likely the government will target them because, as we all know, the government just isn't a fan of cryptocurrencies at this point in time. Number 6, meme coins. So these are things such as Dogecoin and Shiba Inu, Floki Inu, which was a coin made after Elon Musk told everyone what his new dog's name was, which was Floki. There's that Squid Game token that came out around November, I think it was. October, November, somewhere around there. There was also another one going around recently called Grimace Coin. But yeah, they're all just meme coins. They're just made as a joke, essentially. Now, one of the primary problems with meme coins is because they're super cheap, a lot of the newbies don't understand the relationship between the market cap, the supply, and the dollar value. So for example, Shiba Inu is super cheap, but you can't put a few $100 into it and expect it to go to $1, which would put you at like a millionaire, for example, because the market cap is already in the billions. So there's also a maximum supply of about 400 trillion anyway. So according to the math, for Shiba Inu to reach about $1, you would need more than 10 times the amount of the current money supply on the planet to be invested into that coin to push it up to $1. And obviously that's not going to happen. The sole purpose of meme coins is to just enrich their creators. Basically, I think Dogecoin worked a little bit differently than this, but the rest of them, essentially, that's what they're made for. As you could see in the Squid Game coin, it just got rug pulled. The creators just made it, pumped up the price, and then just sold everything and abandoned the project. Now, just because the price is low doesn't mean it's got more of a chance to make you rich. As I mentioned before, there's that thing called a market cap. Now, the lower a market cap is, the more riskier an investment is. But the higher the market cap, the less risky, but the less upside there is, so the less chance there is to make more money with it. So, as a quick example, if there's something that's trading for 5 cents and the current market cap is at 500 billion, in order for that thing to get to 30 cents, the market cap would need to jump to 3 trillion. And if this was the instance in the cryptocurrency coin, do you really think that crypto coin is going to end up being the same valuation as Apple? I highly doubt it. So in short, meme coins are just made as a joke, really. And just because they're trading at a super low price doesn't mean that they're going to make you a lot of money just because they have more of a potential to reach $1, for example, because that's not how it works. Now, the next investment is real estate. Basically, you just buy a house or a land. Very illiquid, which means you can't really just go and sell it the next day or just go and buy it the next day. The price of real estate goes up way faster than what most stocks will go up, but real estate is a lot harder to get into. Okay, so how to go about investing in real estate. So for this purpose, I'm going to talk about how to buy land specifically. If you want to buy a house, you can always have a chat with a real estate agent. But the reason I'm going to talk about land specifically is because not a lot of people are actually aware of this little investment strategy that I'm about to go through, and it's a pretty good idea. So some people think you need all the money up front before you can invest in something like land, which is not actually true. Whereas I believe you actually do need the money up front required to, buy a house. So how to invest in land. You check land developments around your area or around anywhere really, but I think it's better just to have some within driving distance from where you live. You contact the support at that company in charge of the development, and you ask them to let you know when the land gets released to the public. So usually insiders usually get first pick, but that doesn't mean all of it gets picked up, just maybe the best blocks will be taken, but you'll still have your time to shine. Now, once they release it to the public, choose your block and pay a $1,000 deposit ASAP. So that way this solidifies your spot. And eventually they'll send you some contract that you have to sign, usually within the first 2 or 3 weeks after you put that $1,000 deposit in, and have 5% of the land price on standby within the next 6 to 8 weeks. So once they've sold the blocks of land, they have to wait for engineering plans to get through and the engineering contracts to get set up. And once this is ready, that's when you need to pay 5% of the total land value. And then you sign the new contract that they send through. And then in 12 plus months, when the land is ready, this is when you have your whole deposit ready. So have at least another 15% of the land price ready. So when you get a loan from the bank, you avoid LMI, which is lender's mortgage insurance. That's a thing here in Australia. I don't know if that's what they call it anywhere else, but basically it's just something that's expensive, it's unnecessary, and it doesn't really bail you out. It more so bails out your broker. So yeah, there's not really a lot of upside to paying for this. Just save up the extra money. You can call a broker for a chat. It's free. The reason they give it to you for free was because eventually you can become a client of theirs. So in a way, it's like them giving you free service to see, oh, well, hey, this is a good broker, I'll stick with them. So yeah, have a chat to them because they're free. At least they are where I'm from. I'm sure if you sort of have a look around, there will be some brokers who are willing to have a free chat with you just to give you a rough guideline of what you could roughly expect to be able to borrow from the bank. And obviously you need to figure out how much you need to borrow from the bank to figure out whether you can actually afford the land or the house in the first place. So what you do then is you give the broker your regular pay slip. Now, overtime's not looked highly upon. So if you work in an industry that pays a lot of overtime, so I know construction pays a lot of overtime, and overtime's kind of expected in your pay slip, but the banks won't really take into account the overtime portion of your pay slip just because it's not part of your ordinary time earnings. So if a lot of your money comes from overtime, don't expect this to be taken into account when looking at getting a loan from the bank. I hate to be the one to tell you, but that's just how it goes. And if you're a sole trader or like a business owner, you're going to need 2+ years of tax returns. So someone earning $60,000 a year from a business is looked down upon from the bank, but someone earning $60,000 a year from a job is looked a lot more highly upon, just because the job is a lot more secure. Now, I've spoken about this again in previous videos on this channel before, but there are a lot of benefits to having a job as opposed to having a business. And one of them is it's easier to get a loan from the bank, which can then buy you real estate, which is a fantastic investment, whereas it's a lot harder to do this if you're a business owner. So the best scenario you can be in when looking at getting a loan from the bank is having a full-time job, because that's the most stable. Part-time jobs also quite good, but yeah, obviously full-time is what they mainly look for. Casuals, not so much. They kind of see this in the same realm as a business owner, but I guess if you can prove that your shifts are regular and repetitive enough, you can get a loan more easily. Now, you can actually avoid that lender's mortgage insurance if you have less than 20% of the land and real estate value paid up front. If you're in certain careers, such as being a doctor or a lawyer or a CPA, for example. And the reason they do this is because obviously these careers are a lot more stable and they have a lot more potential to pay well in the future. So the bank doesn't see you as a high risk individual of, not being able to pay back your loan, because it's like, oh, well, look at their job. They're obviously going to have work in the future because the economy needs these people, and they're obviously going to get paid more because they're highly skilled. But you're probably better off just having the 20% outright. I thought I'd just mention this here because, that can be an option for some people, but you're better off just having the 20% outright. So yeah, as for a house, you need a 20% deposit outright. So when my land is ready and I'm ready to build a house, I can't do this same sort of dragging out the payments thing with my builders. I'm going to need the 20% deposit outright so I can get the loan from the bank to pay these builders. Now, some builders can lock in prices for 1 to 2 years. And once you have a pretty good guideline of when you're going to have the money ready, probably lock in the price right then and there, just to avoid inflation bullcrap, because obviously the prices of materials and labor is just going to keep going up and up for quite a while. So just something I'd mention, I bought my land for about $325,000, and at the moment it's valued at around $380,000. So that's not bad for a 1-year investment, especially because I've only paid about $16,250 for it at the moment. So obviously I still need to fork out the other 15% once the land is actually subdivided and ready, and then go and get the loan from the bank. But either way, that's a pretty good investment, hey. Now, another thing I thought I'd mention is there are ways where you can literally just hold the land and sell it before you've actually paid for the land itself. But this is outside the scope of this video, and there's some legal loophole in the contract. I kind of know about it, but it's really outside the scope of this video. So that's just some food for thought. If you want to go digging into that yourself, it does exist, by all means, go and have a look, but I'm not going to talk about it in this video. Now, another investment is commodities. So these include things such as gold, silver, oil, uranium, lithium, copper, and wheat. How to invest in these, it's same as stocks. So I know eToro lets you buy things like oil, wheat, copper, lithium, oil. So 2 commodities that have been doing really well lately are uranium, which is correlated with nuclear energy, and lithium, which is correlated with electric batteries, because electric vehicles, and we all know how good electric vehicles are doing right now. Another good commodity to look at the moment is gold. So gold actually does really well historically during rate hike environments, which is something I'll touch on later in the video. But basically, rate hikes is where the Federal Reserve will increase interest rates, which is known as like a rate hike. And gold has done well in these situations, as you can see on screen now. Now, the picture on the right, that just shows gold's price for the past 10 or so years. And as you can see, it hasn't really done a whole lot. But this is because there haven't really been any rate hikes. In fact, I don't think there was any during this time frame. So that's why gold hasn't done so well recently. But as you can see in the middle image, gold has performed well in the past 4 Fed rate hike cycles. So a rate hike cycle is where they increase rates and they increase it again and again and again, like what they're probably going to do soon. So gold might be a good commodity to have a look at the moment, but do your own research. So in terms of my personal stock portfolio, why have I invested in the stocks that I have? Well, my reasons are my own. All right, I'll show you what they are. So I'm not going to talk about why I've invested in all of these because this video is going to be a lot longer than I wanted it to be anyway. But if you want me to talk about why I've invested in these, let me know and I'll make a separate video. But a lot of these stocks were invested at a certain point in time where I had a certain amount of information available to me at the time that led me to that decision to buying that particular stock. And some of them haven't worked out too well at the moment, and some of them have. As you'll see in some of these slides, a lot of them are in the red, but it's more so just because we're in a bit of a tough stock market environment as it is. So I'm not going to sit here and act like I'm a genius, or I'm not going to, hide all my losing positions, because a lot of them are in the red, as you can see. But at the time I invested in them, things were doing well. But either way, here are the individual stocks that I have. All right, I'll show you what I've got in crypto as well. But again, same reason as stocks, I invested in these at a given point in time with a certain amount of information I had at the time as well. And that's what led me to the decision of buying all these particular cryptocurrencies. I don't have any recommendations for any good cryptocurrencies at the moment because the market's kind of a mess. But I know a lot of people will just recommend Bitcoin and Ethereum because they're probably the most likely to appreciate in value in the future. So you can always do that, but either way, I've just listed all the cryptocurrency coins that I own. I also have some in like an earn sort of portfolio. It's where you sort of lock them away and they sort of accumulate interest, which is an offer that Binance gives for some of its coins. I think most cryptocurrency exchanges offer this similar thing, but for different coins as well. So there's that if you're interested. I've also got a SwiftX portfolio, so here's that. As you can see, it's down 23.79%, which is surprising because I honestly thought it'd be down a lot more, but whatever, I'll take it. And what you can see on screen now is basically the value of that little portfolio over the past 6 months. So during this time, I didn't put a single cent in here. As you can see, it had a bit of a rally up, and then it's just been on a slow and steady decline through the past few years, through the past few months. So the VIX. What is the VIX? It basically tracks the volatility in the market. Volatility equals how sudden and drastic the prices can change. It's like how inconsistent it is in a way. The higher the VIX, the more uncertainty there is in the market. So if you hear people talking about the VIX is up, that just means the volatility in the market is up. So don't be surprised if your stocks really move up one way or the other suddenly, because that's basically how the market is acting at the moment. Fear and greed index. So more greed equals prices are likely overvalued and they will probably drop soon. So it's probably a good idea to take profits. So what take profits means is it's just where you basically skim some money off the top and take off some money while you can, while obviously the value of the asset that you're holding is worth a bit more. And if there's more fear, that means prices are undervalued, which means they will probably rise in the coming months. So start averaging in. And what that means is start putting a bit more money into this certain stock or cryptocurrency or whatever, bit by bit during this time period, because it's likely to go up eventually. So in the past, it's usually been a good idea to put money into the markets when there's been more fear in the markets, because that means everything's trading at a cheaper price, which means obviously you'll make more money when it goes up in value. And it's also been a good idea to sell off some stocks and take profits when there's more greed in the market, because usually eventually the stock prices will slowly dip shortly after. But that's just a very general guideline of what fear and greed index is. Again, do your own research. This is just giving you some pointers as to where to start looking. Hierarchy of investments. So I think I'll just mention this. I haven't actually seen this anywhere, but this is basically what I've come to learn. So number one, the macroeconomy, which includes the Federal Reserve policies. So whatever happens in the global market and whatever the Federal Reserve is talking about, that will have a trickle-down effect into everything else. So, for example, number two, the S&P 500 or the overall market. Now, the reason this is second is because data shows that crypto actually follows a stock market, as opposed to some common belief that crypto is a hedge against stocks, which doesn't seem to be true. Why this is number two is because no matter how well some companies are doing, if the Federal Reserve says something like, we're going to stop putting money into the economy, or we're going to raise interest rates, which means that companies are going to have to pay more to borrow money and all their debt's going to be more expensive, then that's going to impact these companies no matter how well they're doing. So that's why, the macroeconomy and Federal Reserve policies are number one. And then that trickles down into the number two slot, which is the S&P 500 or the overall market. Now, number three on this list, the Russell 2000 or smaller cap markets, which is companies that have a market cap of 300 million to 2 billion. So the Russell 2000 tracks 2,000 companies, but obviously not all these companies are quite large. So it will cover some of the smaller companies, which are more likely to be impacted by moves in the market as a whole, which is why this is third, because any Federal Reserve policies that they implement will impact the big dogs, and what happens with the big dogs will impact the smaller companies as well. There's some data to show that the Russell 2000 is a good indicator of where the market is headed. So if the Russell 2000 is starting to dip, more often than not, the S&P will dip after the Russell 2000 has started to dip. And on the contrary, when the Russell 2000 is starting to go up, chances are the S&P 500 will start going up shortly after that as well. Now, that might be a little bit confusing as to why the Russell 2000 is in number 3 and the S&P is in number 2, if usually the S&P follows the Russell. Well, the S&P isn't really impacted by what happens in the Russell 2000. It's just when the Russell 2000 moves in one direction or another, it usually means the S&P will follow in that direction because that's where the overall market is headed. I hope that makes sense. Basically, just because the Russell 2000 moves in one way or another doesn't mean it really impacts how the S&P 500 companies operate. But we'll move on. Now, number 4 is crypto. So no matter how well cryptocurrency projects are doing, if the Federal Reserve is implementing some policies that are going to hurt the economy and the overall stock market isn't doing so well, the crypto market also won't do so well. So that's important to keep in mind. So no matter how much due diligence you do with your cryptocurrency investments, if the overall stock market isn't doing so well, then chances are those cryptocurrencies aren't going to do so well either. Now, another thing I'll mention, no one gets rich from investing. So investing is a percentage game, right? You won't put $500 into the market and then make $500 back in a month. It's all a percentage game. If you make 10% in the stock market, well, that's only 10% of whatever money that you put in. So I thought I'd just mention that because I don't think some people realize that you don't become a millionaire from investing unless you get really lucky on some reckless gamble, but that's very unlikely to happen. It's like buying a lottery ticket. Just because someone got rich from the lottery doesn't mean that that's a good investment with your money. Another thing I'll mention is that last year, there was a lot of finance YouTubers who were tooting their own trumpets, thinking like they're such good investors. But as I mentioned before in that hierarchy of investments, the Federal Reserve was just pumping money into the economy and keeping interest rates low, so it was a lot easier for everyone to borrow money. So companies were able to grow a lot quicker because companies know how to grow their businesses, right? They just need the money in the first place to be able to grow. And in the macroeconomic environment for the last 2 years, with all the money that was being pumped into the economy, it was easier for the big dogs to grow. Obviously, a lot of small businesses took a hit, but the big companies, not so much. They were pretty much fine. So why did I bring this up? Well, because all the stocks were doing well last year, so you could have just randomly picked some stocks and chances are they did pretty well. Everyone was a genius in 2020 and 2021 because the government was pumping money into the economy and there's low interest rates, which is what I just said. Everything was growing, so shut up. So when you see some finance YouTuber talking about how they did so well with their stock picks last year and that they're such a genius and all that, don't buy it because, you know, most people would have done well. Let's see how well they do this year. If they do well this year, then maybe they're a genius, but, you know, most people made money in the markets last year, which is annoying because I didn't really get into it until later in the year. But anyway, timing the market is rubbish, yeah, so you're better off just slowly putting money into the market no matter what the current prices are. Don't try and like buy the dip or anything. There's a lot of data to show that you actually make more money just by slowly investing into the market as opposed to waiting for things to drop. So yeah, just slowly put money into the market. Maybe feed off of that fear and greed index graph that I was showing you before. You know, maybe put more money in when everyone else is scared of the markets, but ultimately just slowly put money in as you go on about your life. Recessions and stocks. So a lot of people are fearful of a recession coming up soon and they're like, oh, sell all your stocks because they're all going to be worth nothing in a recession. Well, the data shows that that might not actually be true. So you can just read what's on the screen right now, but basically once the recession was over, more than half the time the stock market ended up at a higher value than what it was at the start of the recession, which is not what you'd expect. But yeah, that's crazy how that works. Hey, just because the overall economy is growing doesn't mean that certain stocks are going to grow, which is a little bit weird. So here's just some more food for thought. So recently the job report in the US was pretty good, but this might be bad news in terms of the overall economy and what the Fed might do, because now that they realize that there's a lot of people who have jobs than they thought, they're like, well, we can afford to have some people lose their jobs in a rougher economy, so they might raise the interest rates more, which means that everyone's debt's going to be more expensive, which means people are going to have less money to spend overall. But yeah, there's just some more info on screen if you want to read about it. Now here are just some random tidbits that I thought I'd throw in. I don't actually know where I was going to put this in the video, so I just chuck it here. Facebook blamed changes in privacy laws on their reduced profits. So other techs sold off since people anticipated this would be the same issue for things such as Snapchat. So Facebook reported their earnings recently. Now, when they report their earnings, basically it's just they report the money they made and their financial reports and stuff. So whenever you hear people talk about this company's reporting earnings, that's basically what it is. And the stock price will go up or down suddenly based on the earnings report and based on what the financial analysts have expected. So if they do worse than what they thought, the stock is probably going to go way down shortly after earnings. And if they do better than what the analysts expected, usually this means they'd go up, but recently they've still been going down anyway, so that's a little bit weird, but that's just what earnings are. Whenever you watch the other YouTubers I recommend and they talk about earnings, that's what they're talking about. Now, there's some recent news that Peloton might be taken over, potentially by Amazon. Amazon might be able to find a way to integrate Peloton into Amazon Prime because Amazon's got the warehouses for inventory and they've got so much cash to run that business at a loss for years, so they can afford to lose money like that. Peloton is basically those stationary bikes that they were kind of popular during the pandemic, but they kind of died off now that gyms are actually open. Now, that news isn't too relevant now, but it was a little bit relevant at the time of getting this slideshow together. But I thought I'd just mention it anyway because it might be relevant for when you guys go out and do your own research. You might hear something about this and you're like, oh, what's that about? Well, here's the info for you. Russia's economy is smaller than Italy's. So the reason I mentioned this was because a few weeks ago there was a lot of talk about how the Russia-Ukraine situation is going to impact the stock market. And I think a lot of people were overblowing how much of an impact it would have. So the fact that Russia's economy is actually smaller than Italy's goes to show that maybe it's not going to have as big of an impact on the stock market as one might think. So Russia does export a lot of oil, so that may have been where the fear in the stock market came from in terms of the whole Russia-Ukraine situation. But that's just another bit of information to keep in mind, that Russia's economy is actually smaller than Italy's. So yeah, just some food for thought again. The buy now, pay later sector isn't doing too well because the consumer sentiment is low. Higher inflation might result in some people buying stuff now since it's cheaper, but people are scared. So yeah, before investing money into those buy now, pay later stocks, maybe keep this in mind. Chances are it's not really going to do so well in the coming months. But again, do your own research. So these are just some terms I might go over just in case you aren't sure what they mean as of yet. Inflation, so the prices of everything go up over time. There's mixed views on how this impacts stocks. Like there's some graphs saying that it doesn't impact it. There's some graphs saying that they do. There's some saying that they actually help the stock market. So who really knows? But you do end up losing purchasing power. So, you know, what you can buy, the $100, what $100 can buy you today won't buy you the same amount of stuff in 10 years. So that's why you invest your money and whatnot to outpace inflation. The Fed raising rates, so that's the central bank in the United States, and them raising interest rates means the cost of borrowing money is a lot larger, because when you pay back interest on the debt, if those interest rates are higher, that means you pay more money because you pay more interest on the money you borrowed. So that means larger companies can't grow as fast, which means their stock prices don't grow as fast. And this also might mean that people put money into their bank accounts instead because they can get a higher interest rate. Whereas, obviously when there's low interest rates, you're not really going to earn much money by having your money in the bank. So that's something to keep in mind when you're making your investment decisions. Leverage trading. So this is just using borrowed money to invest in stocks. Have a stop loss or you'll owe your brokerage a lot of money. Don't do this. Now, I touch on this later in the video, but this is just something to keep in mind. Leverage trading is like using borrowed money. If you use borrowed money to invest in a stock and it goes down, then you can actually lose a lot more money than you put in the first place. Another note, don't pay for anyone's Patreon, okay, guys? Because that means you're going to be tied to their viewpoints. Now, you could pay for multiple Patreons to get different perspectives, but, you're better off just using their free information and making your own judgment and doing your own research. Now, one example is two YouTubers I really like. One of them, Zip Trader, was talking about don't buy Tesla now at some point because it will probably go lower. Ultimately, he was correct. Now, another YouTuber, Tom Nash, said maybe it's a good idea to buy Tesla now because I don't think it'll ever dip under $900 again. And he was going through all the fundamentals as to why he thought so. Now, ultimately, Zip Trader was right, but these guys both had their own compelling arguments for this case. And they're both two very smart men who provide fantastic information to us all. But the point of bringing this up is if you pay for someone's Patreon, if you're tied to their views, they can ultimately be wrong. Now, obviously, everyone's wrong at some point, but if you're paying someone, you would expect that they're giving you the best quality information, that they're always going to be right. And if not, why are you paying for their Patreon? So I thought I'd just mention that. Just don't pay for people's Patreon, guys. Here's another important tip to know before investing. So there was a research study published in 1973 from the University of Princeton. Basically, it involves them randomly picking stocks, and 98 out of 100 times the random simulation of picking stocks randomly beat the experts. So the most likely reason for this was because there's no emotional investing involved. So when stocks go down, people didn't just sell off. So the reason I brought that up is because don't try and act like you're a genius with this stuff, because ultimately no one's really a genius with this stuff. Like, there's a few out there, but a lot more people think they are when they're not. And also, the stock price that Google shows isn't actually the quote real value of the company. It's just based on rumors, news, and expectations. So the stock price you see has factored in any upcoming possible events. So why I brought this up is because if you see a stock price and you see some news articles saying, oh, well, I don't know, Tesla is going to have flying cars in the next 2 years. Like, they're not, but just for an example, and you're like, oh, wow, I better buy Tesla now because, in 2 years, the price is going to be way up because they're going to have flying cars. Well, the stock price has already factored that in. So when they do ultimately roll out their flying cars, the stock price isn't going to move much because they've already factored this. So here's just the study I was talking about before. If you want to go and research it yourself and have a look, here it is. Now, I'm going to sort of wrap up the video by going over a few terms you might hear when you basically get immersed in the whole stock market world. I'm going to go over a few terms and what they mean, so that way you'll have an idea of what people are talking about when you hear them say these things. So, bull market is where everything's just going up and it's a good environment for stocks to be in. A bear market is when it's a bad economic environment and stocks and stuff are usually going down in value. Hawkish just means that the Federal Reserve is looking at controlling inflation, so they're increasing interest rates. And when the Fed is dovish, that means they're all about decreasing interest rates and maximizing employment. So hawkish is similar to the bear market, and dovish is similar to a bull market. So think of the claws in these animals. Hawks and bears have claws, bulls and doves do. So think of hawks and bears with their claws. They claw away at your money. So whenever you hear the Fed is hawkish, this is probably bad for your money. When there's a bear market, this is probably bad for your money, because when it's hawkish, the hawk is going to claw away at your money. And when there's a bear market, the bears are going to claw away at your money. Active investing, that's just where you basically put a lot of time and effort into it. You are actively involved. Passive investing, that's similar to how you go about index funds. You just put money into it and you just forget all about it and you don't do much with it. Chip stocks. So there's like blue, red, and white. Red stocks are more so China stuff. White stocks are the lower cap stuff. And the blue chip companies are like the massive companies. So when you hear people talking about like a blue chip stock, they're probably talking about something like, Tesla, Apple, Amazon, etc. Market indices, so these are just a good gauge as to see how the overall market is tracking. So there's the Dow Jones Industrial Average, there's the NASDAQ Composite Index, and there's the S&P 500. A little bit more info on them is on screen right now. Pause and read if you want. So dividends are basically where a company is paying you money because you own stock in that company. It's kind of like a thank you for having our stock, here's some money. You'll find that usually super large companies will pay these out because the smaller companies are better off reinvesting their money back into the business. Now, there's mixed views on whether dividend companies are a good investment. On one hand, they pay you money just for holding the stock, but on the other hand, in a way, it might actually be better for the business if they were to use that money that they were going to pay you as a dividend to reinvest back into the company to grow it quicker, so that way the value of the stock you're holding goes up more. There's some more information about it on screen now, but pause and read if you want. Fundamental analysis, same as like a quote value investor. They have like a long-term outlook and they use financial ratios and they buy stuff whenever it appears to be undervalued. Again, fundamental analysis, it's kind of outside the scope of this video. Eventually I'll make a video on what it is, but yeah, it's pretty much just summarized right there. Technical analysis, this is like trends from trading activity, the classic graphs, and like what you'd think of when you think of a stock trader or a day trader or a swing trader. They got like a short-term outlook. They focus on the supply and demand of shares. This takes up way too much time, and more often than not, people are wrong when they go about this. So yeah, that's just what technical analysis is when you hear people talk about it. It's all the charts and stuff. Behavioral analysis. So this is more so looking at the psychology of people, how irrationally they act in the markets. A lot of people FOMO into stocks. They panic sell and they panic buy. A good example is Dogecoin. Everyone sort of FOMO'd. FOMO is fear of missing out. Oh, this stock is going up heaps. Everyone's investing money into this. I don't want to miss this boat. And they put money in, and then obviously it becomes overvalued, and then the price goes back down, and then they panic sell because, oh crap, it's going down. I better sell it before it goes down even more. So this is a pretty good way to look at investing. Dollar cost averaging. So this is just slowly putting money into the market at certain time periods. So for example, you might decide every week or every month you're going to put in, I don't know, $50 into the stock market, no matter what the price is. So when you hear people talk about dollar cost averaging, that's just what it is. It's just slowly putting money in over time. Candlestick charts. So I'm sure you've all seen what these are. Basically, a green candlestick means that the price went up within that certain time period, and a red candlestick means that the price went down in that certain time period. So there's some more info on screen right now if you're interested. That's just basically what candlestick charts are. Call option, it's like a financial contract that gives the buyer the option to buy an asset at a specified price at a certain time period. So essentially you're making a bet that the price of a stock will go up for these. And a put option is a financial contract very similar to a call option, but instead it's selling the stock, not buying the stock. You're essentially gambling that the price of the stock will go down. Liquidation, that just means your stocks and stuff are being converted into money. So for example, if your stock account gets liquidated, which doesn't happen unless you do things such as leverage trading and whatnot. If you just buy the individual stocks itself, this won't happen. But if you hear someone talking about, oh, they got liquidated, that just means all their stocks or crypto was converted into cash. Leverage, I touched on it earlier, but basically it's just using money that you don't actually have, like a multiplier. For example, if you trade at 2 times leverage, for every $10 the stock goes up, it goes up $20 for you. And every $10 that the stock goes down, it goes down $20 for you. Now, this is usually a bad idea because the risk to reward ratio simply isn't there. And you can also get stop losses triggered even when prices just fall down to a certain point, even for a split second. So a stop loss is where your account will basically sell that stock if it drops below a certain price, just to avoid you losing too much money. Again, it's kind of outside the scope of this video, but basically leverage trading is sort of like using money that you don't have, but it's a lot riskier. Short selling, so basically you're just gambling that the stock will go down. Again, there's more info on screen if you want to read about it. A short squeeze, again, there's more info on the screen if you want to know about it, but this is what basically happened with GameStop in early 2021, which is not when I was in the investing game, but if I was, I probably would have jumped onto this craze as well. Another thing, when you hear people say buy the rumor, sell the news, basically what this means is they're buying something because there's the possibility that, something could happen to this stock or something really good's going to happen, possibly, so you buy it now. And when everyone knows about it, that's when you sell it. So what this slide here is showing is it's just showing a lot more information that I have on a couple of other Word documents. Eventually, I'll make videos on this as well, but as you can imagine, I haven't gone over absolutely everything there is to know about the whole investing world, but everything I've spoken about in this video is basically what you need to get started. And on top of that, if you watch my other video on who I recommend to watch, if you eventually just keep watching those channels I recommend, you'll slowly get the gist of this whole stock market thing, and then you'll be able to go and make your own sound investment decisions yourself. So yeah, this video was basically made just so that you guys have a good idea of where to start looking in your investment journey and some foundational concepts that you can then build upon when you start investing yourself, because I know this whole thing can be pretty daunting. But I hope that everything I've touched on in this video has really cleared a few questions you may have. If you have any more, leave them in the comments section and I can answer them when I can, but this should be more than enough to get you guys going. So good luck with your investment journeys. Remember that this won't make you rich, but it'll make you a little bit of extra money. Certainly a lot more than just putting it in the bank or having it sit under your mattress. And eventually, in 10 or so years from now, when you've got a lot more money to play with, you can make a lot more money in the stock market because you've spent the last several years building up the knowledge that it takes to make some passive income. We're all going to peak in our 30s and possibly 40s because we're spending the time now to build a foundational set of skills that'll help accelerate us ahead of the competition in the future. So that's the video. That is all.